Hi, everyone. I see people are coming in off of the waiting room. Welcome tonight. It's a little past 8:30 and thanks for showing up. My name is Debbie Schwartz. I'm the founder of Road to College and the Paying for College 101 Facebook group. And I'm here tonight with Chris Upkarians from Juno. We are going to talk about paying for college, also in particular, where you can get the lowest interest rates. Let me just give you a little bit of housekeeping before we get into all the details of the information. This is technically a Zoom meeting, so as you notice, you can see if people have put their video on, which we kind of like it if you do. It's just nice that people see real faces. You can see people's faces. We everybody who has come in is muted. If you can stay muted, that would be great. But if you have a question, it is perfectly fine to unmute yourself and ask that question. It might be helpful. Sometimes it's just hard to type in the chat exactly what you ask. So feel free to unmute yourself and just say, excuse me, and ask the question. But otherwise, it'd be helpful to keep yourself muted. Put your questions in the chat. Chris will be going through information and I'll be checking the chat. I'll be looking at questions. I might interrupt Chris. I'll try and respond and answer as many questions as I can in the chat. And then definitely at the end, we'll go through as many questions as we can. I think we're going to get started. Chris, I'd love if you introduce yourself or give a little background. I also know it might be in your slides, so however you want to get started.
Sure, happy to. And thanks again for having me, Debbie. And appreciate everyone's time for being here today. So I'm Chris Upkarians, as one of the co-founders of a company called Juno. Before that, I did undergrad at Duke and then went to business school a few years later. And what Juno does is a quick backstory. So about 6 years ago at this point, when I was going to business school, one of my classmates and I decided to try an experiment to see if we could bundle together a bunch of different students who needed to get student loans and ask if banks and credit unions would be willing to negotiate on the rates and the terms that they gave to the group. And it ended up working. So what started as an experiment, just so that I could afford to pay for school, turned into Juno, which now does the same thing for about 180,000 people today. And so I have become a reluctant expert on many things related to student loans. And I'm happy to answer any and all questions that folks might have, whether it's during this webinar, at the end during Q&A, or even offline afterward. So to get into today's topic, we're going to cover a couple of different things over the next 45 minutes, roughly. If you have any questions as we go along, feel free to type them into the chat box that you'll see in the toolbar of the Zoom menu. I'll pause along the way and see if there's things that we can answer live. If not, we'll save a few things for the Q&A section at the end. To start with, we're going to walk through one of my favorite topics, and it's a truncated version of a discussion around negotiating financial aid award letters. And even though it might not seem relevant if, let's say, you've already put down a deposit and you know where your child is going to school, there are some key things that you might want to keep in mind for each year that you'll apply for financial aid in the future. We'll move on from that to spend a bulk of the presentation talking about the general landscape for student loans in the United States. And then there we'll cover the different federal student loan programs that you have access to, how those compare to the various private loans that are available in the market, and walk through a decision tree to help you better understand when each loan product makes sense and when it doesn't. And within that section, we'll also leave you with a bit of a two-slide cheat sheet that you can always refer back to that covers some of the key elements that you should understand about each loan program. Finally, we'll wrap things up with just a few minutes on how to go about finding the lowest private loan rates if it's something that you end up looking into. And then I'll save as much time as possible for Q&A. Afterwards, we will send copies of the slides and a recording of the webinar. So if at any point you need to drop off, please don't worry. If there's questions that you'd like to ask that you don't get a chance to before you drop off, I'll also include the contact information for my team so that you can reach out and book free one-on-one consultations with us for June, July, August, and September. That's really all we do. We're around to help whether you use a Juno product or not. So please don't be shy. We talk to hundreds of people every week, and we're more than happy to try to be helpful. So I'm going to start off with a section on negotiating financial aid award letters. Some of you might have seen a longer version of this presentation a few weeks ago. And I'm going to really just cover a few of the key things that are helpful to understand, because a lot of people have gotten their financial aid letter more recently than they would have in previous years. Traditionally, you would have gotten this in March, April. This year, because of all of the delays that have happened with FAFSA, it has taken many people a lot longer to get them, and I know that some people still haven't even received them. Once you have it, and assuming you already do, I just want you to think of it as being a first draft and not a final draft. There's two different types of financial aid that could be called out in whatever you get from the school. One being merit-based and another being needs-based. And we're going to talk about both of those for about 5 minutes total. I want you to, as a general principle, just understand that a lot of people appeal their financial aid award letters every year. And you can appeal both merit-based and needs-based. A lot of schools, not all, but a lot, already assume that a good chunk of the people they've admitted will be appealing and save a little bit of their budget in order to accommodate that. And the worst thing you're going to hear is a no. There's no real negative action that a school is going to take if you're politely asking for a little bit more help to make ends meet. And just to clarify, when I talk about appealing for more aid, I'm talking explicitly about grants and discounts, not more loans. The goal of this section is to just help you understand some of the levers that would allow you to pay less money out of pocket in order for your children to attend any program. So a quick overview of how the appeal process works, and this is with respect to need-based financial aid. So as of this year, schools are actually required to give the ability to submit a formal appeal for more aid. There's a section, and it's actually supposed to be published on the school's financial aid website. If you can't find it quickly, you can email them and ask them where you could submit an appeal for more aid. But they should have a formal process where you would, one, draft and submit a letter that explains why you think you deserve more aid. And we'll go through a few of the reasons in a moment. You might be asked to submit specific types of documentation that would support your claim. The school then has an undefined amount of time to review this and to give you a decision. This year, because there's been so many delays with respect to FAFSA and getting your award letter, I really don't know how long it might take for a school to review your appeal and to give you an answer. It likely won't happen very quickly, but key takeaway, there is a process. Every school has to have this process now, and you should look into asking for a little bit more money. Now, I'm going to talk for just a second about some of the key things that, key reasons why you might want to appeal for more needs-based aid that might not be immediately obvious. When you filled out FAFSA, a lot of what the financial aid office is doing is they get a bunch of different inputs about you and your family's financial situation. And then those inputs go into a formula that defines your student aid index, which is just the terminology used to determine roughly how much aid you would be eligible for from a given school. Now, those inputs, and primarily FAFSA, are based on the 2022 tax year. So FAFSA by default is pulling your 2022 taxes The financial aid office, all they know and all they see is what's from 2022 and anything else that was already included in your financial aid application. A lot of things have changed for a lot of people since 2022, and perhaps even since the application for financial aid was filed. So I would just say if there's been any kind of change in uh, family size, in a downward revision in income, a job loss, unfortunately, if someone has passed away or if there's been materially increased medical expenses in the family, these are all reasons that are highly valid to, this is information that you should give to the financial aid office so that they can reconsider how they calculate how much aid your family might be eligible for. Even if you don't tell them, there's no way for them to. The second key thing to keep in mind is if you, this is not just a one-time thing. If you or your child are an incoming freshman, then you'll be filling out a financial aid application, a needs-based version, and you'll fill out FAFSA every single year. If anything changes in the second year, third year, fourth year of school, then it's to your benefit to let the school know what those changes are to see if they can make some adjustments to the formula that they use to define how much aid you can get. I'm going to pause here to look at a few of these questions.
Yeah, Chris, there is a few questions. One about can you appeal to a public school? And then the second about appealing after you've accepted.
Two great questions. Yes, you can absolutely appeal to both public and private schools. Each school has a slightly different amount of money that's available, but you can absolutely appeal both. When it comes to need-based financial aid, absolutely it's okay to appeal after you've accepted admission to a school, because the way that need-based financial aid is viewed is slightly different than merit-based. Merit-based financial aid, your likelihood of having something approved after you've accepted admission to a school is a lot lower. It doesn't mean that the chance is zero. It just means in a lot of cases, the school is using that merit aid as a carrot to get you or your child to accept admission and to go there in the first place. And if you already have, then it would weaken your negotiating leverage. So really just moving on to a quick discussion about merit-based financial aid. This, again, because we're a little bit later in the year, may not apply to everyone, but some schools have moved back the date by which you have to accept admission far beyond what they normally would. And so it will apply to a few folks right now. If you or your child have been admitted to more than one program and another one, let's say one school has given you significantly more aid than another school, but you want to go to the school that's offered less aid, then it's a great reason to politely ask the school that you want to go to more for a little bit more help to make ends meet. And what we pulled together that you can also access when we send the presentation tomorrow is a quick template that quite a few people have used to ask for more merit-based aid from both the admissions office and the financial aid office. It's okay to ask both the same question. Some schools will respond from one department or another. There's no really one size fits all here. But please feel free to use this template. Every couple of days, somebody sends me their appeal letter and asks if I'd be willing to glance it over and offer my thoughts. So you're more than welcome to send them by me as well. And I can take a really quick look. But just know this is a resource that's here for you. And at the end of the day, if you're not asking, the odds are that somebody else is. And if there's any money that's left over, somebody else will get it and you won't. And the school is not going to rescind admission or take any punitive action if you're politely asking for a little bit more help to make ends meet. All right. If there's any more questions on this, I'm more than happy to answer them towards the end. But now we'll move on to really the bulk of the conversation, which is how undergraduate student loans work. So let's start with a general overview of what the different ways are that you can use loans to pay for school. The first section was about how do you reduce the amount of money that you have to pay to the school. The second section is about how to make the right decisions about which loan programs to use and when. So there's two different types of federal student loans that you can use for undergrad. The first is called a direct or a Stafford loan. And this is what I'd say pretty much every financial aid officer would say is the starting point. These are loans that are directly in the name of the student. They have a lot of protections built into them in case there's some sort of financial difficulty after the student graduates. And they have lower rates than any other federal student loan program. We're going to go through it in a lot more detail, but just know in general, if student loans are necessary, the direct Stafford loan is where to start. Now, the only downside of the Stafford loan is that the amount that can be borrowed for a given year of school is rather low. And so a lot of people end up having to use the second federal loan program that's called Parent Plus. This was created to help parents and families pay for the entirety of what school costs. But the price of these loans is significantly higher than the first loan program that I spoke about. Because the price of these loans is a little bit higher, there's a lot of people who will consider checking what rates they qualify for from the private market. And so the first two loans I talked about, these come directly from the Department of Education. As long as you qualify, everybody gets the same rate. If you have great credit or a high income, you may qualify for lower rates than what you can get through the federal programs from private banks and other types of lenders that exist. So for the next couple of minutes, we'll go through the key things to understand about each of these three types of loan programs. I'm going to pause for one moment to see a few questions that have popped up. I'll return to that question in a moment. So to start off with, we'll walk through 4 of the key financial terms that apply to each of these loan programs. What's the rate? What type of rate is it? Is it fixed or variable? Is there an origination fee? And how much are you allowed to borrow through the program each year? We'll also talk about when do payments start? How do you qualify for the loan? Whose name the loan is legally in? And what kind of protections exist in case you face any sort of hardship while you're paying back the loan. For the first program, we're going to go back to the federal direct / Stafford loan. So this is, as I was saying, where you should start. These loans are made only in the name of the student. So the student has to take this out directly, and you get it by applying for FAFSA. For all new loans that are originated from July 1st and on, there's a new rate that you'll be charged. And so I'll get into this more in a minute, but Congress set a formula that defines how much student loan rates are. They change for all new loans that get originated each year. And so for this, for the upcoming fall term at the schools that your children might be going to, through this loan program, the rate's going to be 6.53%. It's a fixed rate, and there's a 1.06% origination fee. Origination fees on federal loans are not money that you pay out of pocket, but I'll give you a quick example. If we were going to, let's say your child is going to UCLA, and you owe them $100. In order for UCLA to receive $100, you have to borrow $101.06. And so that origination fee effectively gets added to the principal balance that you borrow on day one. This origination fee isn't very large, but when we flip in 2 minutes to the Parent Plus program, that has a much larger origination fee, and it becomes more meaningful to consider when you're comparing it to your alternatives. There's no I'd say, traditional credit check required to qualify for the direct loans. And you don't have to make any payments on these until 6 months after graduation, or until the student stops being enrolled at least half time in school. So as long as they don't drop out, you can avoid making any payments until 6 months after graduation. The best feature of these loans is that there's a lot of protections that are built in. There's a pretty wide safety net. And so if your children can't afford these loans after they graduate, let's say they're taking longer to find the job that they want or something happens, then they can basically limit the amount they have to pay each month to a pretty low percentage of their discretionary income after they graduate, which also means that if they're not making any money, their actual payment would be zero. And if they're working, sure.
I'm sorry. When you say federal direct loans, that's Stafford or that's Stafford
Yes.
and Parent Plus? Only Stafford.
Yes, this exactly. This slide and this section is specifically about Stafford.
Okay, just double checking. Thank you.
Sure. And the other great feature about these is that depending on what career your children go into, there are formal student loan forgiveness programs that have been in place for a long time. And so if they go into teaching or certain careers in public service or certain not-for-profits, they can have their loan balances forgiven after 10 years. The downside of this loan program is simply how much someone is allowed to access through it each year. And so what you'll see on this slide is a breakdown of the borrowing cap, depending on whether the student is classified as dependent or independent. Now, the definition for a dependent or an independent student is not the same as what you'd see on your tax returns. The Department of Education has a pretty specific set of qualifications for what makes somebody independent. And you can see those in the right-hand side of the slide. If your children are 24 or older, married, veterans, orphans, emancipated minors, then they qualify for the higher annual loan limit. Everybody else gets classified as a dependent student, which in essence means for the first year of school, they can borrow $5,500. For the second year, they can borrow $6,500. And for the third and fourth years, they can borrow $7,500 each. An important thing to keep in mind, though, is that you can't, this is not retroactive. It's a use it or lose it type of loan limit. If you get to junior year, then, and you haven't used federal direct loans for freshman and sophomore years, you can still only borrow $7,500 in junior year to pay for school. You can't go back and use the $5,500 and the $6,500 that you were eligible for, but didn't use in the previous years. I'm going to pause for one moment to see some questions here.
I was just answering questions about
Sure.
confirming. People were asking, when does the interest rate start to accrue? The difference between unsubsidized and subsidized loans. Interest accrues on unsubsidized loans as soon as it's dispersed, on Parent Plus loans as soon as it's dispersed, and then on subsidized loans, that is why it's called subsidized, is because interest does not accrue while the student is in college.
Exactly. Here's a question of what happens if your student is in a 6-year program or a program that's longer than 4 years. So there's a lifetime limit on this loan program. That's the last row in the table. The reason why that lifetime limit is larger than what you see for the first 4 rows is because you can borrow a little bit more money through this program if let's say the student takes longer than 4 years to complete their program, but you'll still hit that lifetime limit before a 6-year program, for example, is finished. We're going to return to this point that I'm about to make in a few minutes, but there is one way So another really key tip to keep in mind. If you end up getting denied access to a Parent Plus loan, then there's a process through which your child can be classified as an independent student. And so they could be allowed to borrow more money through the direct Stafford loan program than they otherwise would be. Otherwise, you should just consider the loan limits on the left-hand side of the column for most people. There's a question here on, does that amount get split per semester? If you need federal for the second semester or junior year, can you take the full $7,500 then? Yes. So the cap on this is per academic year. So if you decided not to use any loans for the first semester, you could still borrow the full, let's say for freshman year, the full $5,500 for spring semester.
Chris, there was a question about, it looks like somebody initially decided to decline the unsubsidized loan, but since then their situation has changed, and this kind of question applies in general. Can you decide later in the year to take out the federal direct loans? If you decline it initially, does that mean you can't ever go back in and take those loans for the same year?
You can go back and get it. Email your financial aid office if you find yourself in that position, because the way that they process this, like typically, if you're doing it early enough, in your student aid account with the federal government, you can effectively opt into these loan programs. But it's always helpful to email your financial aid office, let them know what your plan is, and if they have any specific instructions for you that might differ from a standard process, especially this year. But yes, you can access it later as well.
And that applies, I mean, for all the federal loans, even Parent Plus loan. If you decide in the fall, you're not going to take it, but something comes up and you want change your mind in the middle of the year, you can take it then. My, 2 cents on the topic of taking the federal direct loans is, most people, there's no harm in taking the loan. And if you're not sure if you're really going to need it, because you can see that if you don't take it in the first year, you can't in later years, you can't go back and get that amount. And so sometimes it's really better to borrow it. And if you truly realize that you don't need it at some point, then you pay it off, but at least it's kind of like an insurance that you had it. And so, unfortunately, we see that families aren't the best at figuring out how to pay all 4 years of college, so every year they might kind of have to figure it out again. And sometimes things come up. And so you didn't really expect that you might need to borrow later on. And so it would be a good thing if you had borrowed that money to begin with, and then it just gives you more flexibility. Just something to think about.
Sure. 3 great questions that I'd love to respond to. So I see one here about, where does the money go? With all student loans, whether it is the 2 federal loan programs we're talking about or private loans, the money goes to the school first. So the school will receive the funds on something called the tuition due date, which is typically around when classes start. And if the amount that you've borrowed is greater than what you owe them for that term for tuition and mandatory fees, then the financial aid office typically opens, there's a bursar's account that you can log into. Think of it as just a separate account that they open for you. And then you can wire the extra money that's in there to your personal account and use that to pay for living expense. That process is the same no matter where you get the money from. The second question is about, are there any prepayment limitations? With both federal and private loans, you can pay these back early with no penalty. And so if you end up borrowing more than you think you needed, then my recommendation would be, don't just save that money to use it for school next year. If you really don't need it, then pay that extra amount back early and then get more money next year if you're going to need more money next year, so that you're not accruing interest on a larger balance than you need to hold. And then the third question that I saw here is, hold on, I just lost it, about subsidized and unsubsidized loans. So there is a cap on, so some people in your financial aid award letter might have been told that the $5,500 that you're allowed to borrow through the direct program, part of it is subsidized and part of it is unsubsidized. That's going to be based largely on an assessment of how much financial need you have. You cannot get all $5,500 subsidized. There's a lower cap on how much of that $5,500 can be subsidized, and you cannot increase that cap. So you should just know if you already have that, check what size, how much of that loan is subsidized. It likely already is the cap of what you would be, of what anybody would be eligible. All right, I'm gonna move on to Parent Plus loans now. But if we have more questions on this, again, I'm more than happy to stick around for as long as it takes to answer them at the end as well. Before we move on to Parent Plus, this is the first step of our decision tree, and it's pretty simple. If you don't need more than $5,500 to pay for the first year of school, then you can sincerely stop here. I wouldn't consider looking at other loan programs very much if $5,500 covers the needs for the following academic year. If you need more than that, don't worry, because at this point, I think the vast majority of people do. And so that's what the next stage of this decision tree is going to be about. For the next 5 minutes, we're going to talk about the pros and cons of the Parent Plus loan program and when it makes sense to look at private loan quotes in case you're able to get something that would be preferential to the Parent Plus loan program. To start with Parent Plus loans, the slide is going to look just like the one we walked through 5 minutes ago. So the key differences between this and the direct Stafford loan are, one, this loan is only in the name of the parent. The student isn't legally on this loan. It doesn't show up on their credit report. They don't have an obligation legally to pay it back. If this is something, if there's a shared responsibility that you want to instill around this loan, it's a discussion you should have, because a lot of people, students, don't even know that these loans exist because their parents either assumed that they also knew about them or otherwise didn't tell them. Two, the amount that you're allowed to borrow through the Parent Plus loan program is a lot higher than what you can get through the direct Stafford loan. And that's simply defined as the cost of attendance. So you can borrow all the way up to the cost of attendance number that's published on each school's financial aid website. And it's a specific term that means tuition plus mandatory fees plus insurance plus some allowance for rent and food and personal expenses that each school updates every year. And so if you are using federal loans, my general recommendation would be to use the up to the limit of what you can get through the direct Stafford loan first, and then to borrow the remainder of what you need from the Parent Plus loan program. Now we'll go through some of the financial metrics around it. So I'd say the other thing you probably have noticed by now is that the rates and the fees on this program are a lot higher than what we saw on the direct Stafford loan. For all new loans that are originated after July 1st, the fixed rate on these is 9.08%, and they come with a 4.2% origination fee. To use the same example we did before, that means in order to pay $100 to UCLA, you have to borrow $104.20, and then you'll be accruing 9.08% interest on that new total amount. Unfortunately, this is the highest rate that we've seen in the Parent Plus program. And again, it's just defined by a formula that Congress set up that's also just based on general market interest rates. while there's not a traditional credit check to qualify for Parent Plus, on the next slide, we'll walk through a few specific reasons why the Department of Education indicates that somebody might be denied access to one. And we'll also talk about what to do in case that did happen. Now, another really important tip to keep in mind here is if you want to use a Parent Plus loan, you have an important choice to make, which is when you start making payment. When you opt into a Parent Plus loan using the federal aid site, there is a drop-down menu that asks when you'd like to make payments back, and you can either start making payments 60 days after the money is sent to the school, or you can delay making payments until 6 months after the student graduates. Be careful about making a selection that aligns with what you want. And if you've already accepted a Parent Plus loan, but you're unsure what you selected, it's a great time to email the financial aid office and let them know what your preference actually is. In terms of hardship protections, there are some for the Parent Plus loan program. They're not as comprehensive as what you saw for the direct Stafford loan. But you should know that there are some programs that allow you to limit the amount that you need to pay to a percentage of your income, not as friendly as what we saw in the prior loan program, but still a safety net that exists under this that does not exist for private loans. I see a question here really quick on, okay, I see a few here. Let me wrap up this slide and then I'll return to a few of these questions before we move on to talking a little bit more about how private loans compare to this. So common questions that I get are, when does interest start accruing on Parent Plus? And it's the same as the answer that Debbie gave before, which is when the money is sent to the school. If you borrowed $50,000 through Parent Plus for the full academic year, $25,000 would be sent in the fall and $25,000 would be sent in the spring. You would start accruing interest on $25,000 starting in the fall, and then on the full $50,000 balance once the second half of it is sent in the spring. So it's not based on when you accept the loan, it's based on when the money actually gets sent to the school. Who's eligible for a Parent Plus loan is exactly as it sounds, just the parents of undergraduate students who are enrolled at least half-time in an eligible school. And there's no way to actually add the child's name to the responsibility or to the legal documentation for a Parent Plus loan. If you haven't already done so and you want access to this, make sure that you fill out FAFSA. A lot of the bugs that existed earlier in the year have thankfully now been fixed. And so if you fill it out now, you would still have time to get access to a Parent Plus loan for the next semester. And there's a couple of specific reasons why you might be denied. These are directly from the Department of Education site. There's not a credit score cutoff for Parent Plus, but if you've had a recent bankruptcy, large debts that are more than 90 days late, wage garnishments or tax liens, then it's possible that you get denied access. You can appeal if you think that the decision is wrong. And if you lose that appeal, then your plan B is to ask the financial aid office to allow your student to borrow the larger loan amounts under the direct Stafford loan. So you end up not being allowed to use Parent Plus. Again, the student can borrow instead of $5,500 a year for freshman year, $9,500, and so on for each subsequent year. I will pause here to see what questions we got.
So for that loan, the Parent Plus loan, they don't check credit, but is there a debt to income ratio?
There's not a published debt to income ratio that's used. So really there's not, it's kind of surprising because it's the only loan program for which one does not exist, but there's not a debt to income cutoff, nor is there a credit score cutoff. So I see one question here on someone who didn't receive any need-based aid and got a 4.5% private loan rate from Sallie Mae. Would you decline unsubsidized federal loans and just do private? It's possible to get 4.5% private student loans today, but congratulations. It's typically associated with, I'd say, stellar credit, and somewhere between 5 and 10% of borrowers qualify for the lowest rates that are out there. I would certainly consider that plan of action. I would also say if that Juno could match that 4.5% and give you 3% of your loan amount as cash back, which I'll get to at the end. So please do consider it and give us a chance to match and beat that from Sallie Mae. Let's see. If you'd like, so question for Mary Ellen here on figuring out what your monthly payments on Parent Plus loans would be. So we built a calculator to answer exactly this. If you'd like, we can include it in the follow-up email as one of just a resource and a link. You don't have to sign up or do anything. You can just enter the loan amount that you'd borrow for Parent Plus, what year of school the student is entering, and then you'd see what your monthly payment would be after they graduate. So I'll make sure that we share that. Unfortunately, grandparents cannot apply to Parent Plus loans. Here's a question on someone who's received a statement that their credit was approved for a Parent Plus loan, which I think generally just means that you weren't denied. But the school might not have moved forward yet or made it available for you to actually opt into the Parent Plus loan. In your federal aid portal, there should be something, a notification for a master promissory note. That I would have expected it to have popped up by now. If it hasn't, I would ask your financial aid office directly what next steps you should take. You do not need to reapply. Reapplying would actually mean filling out FAFSA again, so don't worry about that. And don't feel too time pressured here because the vast majority of tuition due dates aren't until some point in August or September. And so you have plenty of time to opt into using the Parent Plus loan if you've already filled out FAFSA and you've already been approved for it. Great question here. Do we do a new loan annually? Yes. So for both federal and private loans, you apply for 1 year worth of loans at a time. The cap on what you can borrow in any given year through Parent Plus or private is always that cost of attendance number. Sometimes I hear folks who say, okay, the borrowing cap is $100,000. I only need $50,000 for the upcoming academic year. I'll just borrow all $100,000 today. And candidly, I would not recommend doing that because you will be paying extra interest on an additional $50,000 worth of loans that you don't need for another full year. And the rate environment today is candidly the highest it's been in quite a long time. So I would just generally recommend, even if you're in that scenario, still only applying for 1 year's worth of loans at a time. The standard repayment time for a Parent Plus loan is roughly 10 years after the student graduates. If you opt into different repayment plans, it could take shorter or longer. And because there's no prepayment penalty, you can still pay these back early if you wanted to.
So Chris, I just wanted to comment, you know, Jeff, who nicely shared that he got a 4.5% interest rate, which is, you know, excellent. I don't know what, and you said you got from College Ave. I don't know what their lowest rate is, but it's got to be close to their lowest rate they're offering. And
Yeah.
the thing to keep in mind, and when you're comparing, you know, what interest rates you might have been offered versus somebody else, is of course, you know, a bigger part of the credit of the interest rate is going to be based on your credit history, your credit score. But the other part of the interest rate is based on what your configuration of what you asked for, or what you're going to select. So when I say configuration, it's based on how quickly you're going to pay back the total loan. So if you said, you know, you want a loan for 5 years, 7 years, 9 years, the longer it takes, the further out you say you want to pay back the loan, quite honestly, the higher the interest rate they offer. It also depends, the interest rate is based on when you decide to start paying back. Are you paying back immediately? Are you going to wait until the student graduates? Are you paying a smaller fixed amount now for $25? So that impacts what the interest rate is. So there's a few different features that, you know, Jeff might have chosen that, in addition to his excellent credit score, was the reason why he was offered the lowest rate. To tell you the truth, and just think about it from the lender's point of view, the faster you are willing to pay back the loan, and the faster you're willing to start with, the faster you're willing to start pay back the loan, and if you're willing to, you know, pay full payment amounts from the beginning, and you only want it, and you take the shortest amount, which is usually 5 years, you tend to get the best rate, because you are showing that you're the lowest risk for them, because you're paying back as quickly as possible. The longer you take to pay back, you've increased your risk. So that could be a reason why the same person, the same credit, they get different interest rates. It's because what they've asked for.
Thank you very much for that overview, which is probably a good segue into just a general understanding of how private loans work. And then I certainly see a few great questions here that I'd love to return to in about 5 or 6 minutes as well. So the reason why private loans can make sense for some folks is because, think of it this way, the Parent Plus loan program, everybody gets the same exact rate as long as you qualify. And if you have 850 credit, or you have significantly lower, as long as you meet, as long as you don't get denied, then it's the same price for everyone, which opens an opportunity for some lenders to come in and provide lower rates to folks who might be a pretty low credit risk. And so there's ways that you can check what private loan rates you might be eligible for without having to do a hard check on your credit. And so if you're curious, you can kind of see where you stand and what your options look like without any downside. It's called a rate check experience. Debbie's a few times posted a link to our site where you can go through and check your rates without any impact to your credit until you submit a full application. And so if you're curious, I'd recommend just trying it. Private loans typically have no origination fee. None of the companies that Juno has ever worked with have origination fees. The interest rate, as I was saying, it varies depending on what your credit score is. And you can choose whether to use a fixed rate or a variable rate. Candidly, I'd always personally use a fixed rate only, and that's always an option that's available to you. In order to qualify, you typically do need to meet certain debt to income requirements and have a credit score above 650. This varies a little bit depending on your scenario, but just know that that's generally the bar. And typically, in over 90% of cases, these loans are in the name of both the student and the parent. So I'd say people are co-signed on the loan and have shared responsibility for paying it back. To the point Debbie was making before, one of the key things is that there's three things that you can choose when it comes to a private loan. One is when you start making payments back. Two is how long the term of the loan is, and three is fixed or variable. For when to make payments back, you can delay making payments all the way up until 9 months after you graduate, or you can start making full principal and interest payments roughly 30 to 60 days after the money is sent to school. The third option is that you can do something called interest only. So you are literally just paying off the interest as you go along, so that at graduation, the amount that's owed is greater than what was borrowed. And the fourth option is something called minimum payment, where you pay $25 a month while the student is in school, and you start making full payments either 6 or 9 months after they graduate, depending on what lender you're looking at. The reason why a lot of people opt into that $25 monthly program is the moment you connect your bank account to a loan servicer, you get a 0.25% discount. It's called an auto pay discount on the rate that you're being charged. So those are the four options you generally have. You can generally choose whether you want a 5-year term, a 10-year term, a 15-year term, and depending on the lender, some amounts in between. But the real downside of it is that you don't have hardship protection like you do in federal student loans. So what you're trading off here is, if you qualify for lower rates from the private market than what you get from the Parent Plus program, you're trading off the insurance effectively that's built into Parent Plus. Some of the protections that come in case you're unable to pay it off, for potentially lower total cost from a private lender. And just general considerations here. I would only consider this after, I'd say in most cases, after a student has used that direct Stafford loan. Now things are a little bit different if you're qualifying for the 4.5% rate, and that rate is actually cheaper than what you can get. You can get more on your deposits today than that 4.5% rate, but that 4.5 is really a promo that is typically only associated with people who want to do immediate repayment. So you're making full payments while the student is in school, and who select a 5-year repayment term. So you're paying back the full amount in 5 years from the day that you borrow it. It's less often selected than other loan types. Putting that scenario aside, I would generally use the direct Stafford loan first before looking at Parent Plus and private loans. And really the two reasons why we see people who use private loans instead of Parent Plus are: one, if you qualify for lower rates, makes sense. And second, if it's important to you to have the loan be in both the name of the student and the parent. And as I was mentioning on the last slide, at this point, the vast majority of private lenders allow you to do a soft check and see what rates, called a soft rate check, which means you can see roughly what rates you qualify for. They're fairly accurate without doing a hard credit check. A hard credit check impacts your credit. The soft credit check does not. And so if you're curious, there's a lot of places where you can go about and check what rates you might be eligible for. I'm going to pause there for a moment. I see quite a few questions that are popping up. I've seen this question a few times now about what happens if you don't need loans, any type of loans, until the spring semester. You have two options. One, you can delay applying or you can delay accepting a Parent Plus loan until the spring. You can delay applying for a private loan until, let's say, December, so that the money gets there in January. Or you can also actually just apply today, and there's an option, basically a drop down typically on most applications that says, when do I want the money? And you can say either for the full year, for just the fall, or for just the spring. And so you'd select just the spring.
Oh, Chris, it's a good question. Sorry, I was just going through answering some
Sure.
questions, and I think this one's worthy to share with everyone. Person is asking, I thought I needed to wait for the school invoice before applying for a private loan.
Great question. So technically, no. So again, the cap on what you can borrow is the cost of attendance. Hopefully you don't have to borrow the full cost of attendance. If the school invoice comes back and let's say you don't actually have to pay as much, you can always reduce the loan amount on a private loan by contacting the lender and having them reduce the loan amount without having to apply again. So that actually is fairly common behavior that I see, is folks who apply for an amount now and then maybe a month or two from now decide, before the money is sent to the school, might decide that they don't actually need as much, and so would contact the lender and ask them to reduce the loan amount. And let's say after the money is sent to the school, if it's a few months later and you realize you don't actually need as much, then you can prepay the extra amount that you don't need, just using the loan servicer portal that you can log into. Conversely, if you need more money than what you've currently applied for and been approved for, then you typically need to apply again for the higher limit.
So Chris, there were a few questions which I've answered, but kind of about for private loan, how much impact does the student's credit score, or even the fact that the student doesn't have income, how much does that impact the interest rate that they might be offered?
Very little to next to none.
Right.
For undergraduate loans, the primary driver is the parent's credit score and income. Most students don't have long enough credit history and aren't working in order to be a meaningful contributor to how the rate is calculated. That changes for graduate school.
Right.
But
if
for undergraduate,
by chance your student does have like a decent credit score, because maybe they've been working on it since they're younger, or maybe they've had a job, or maybe they're going to continue their job through college, it could help, but not having this is not going to hurt.
Exactly.
I'm just gonna,
Okay.
I did answer this a few times, but I thought maybe we should just
Sure.
answer it again. A few questions about can the other parent who didn't fill out the FAFSA be the one that takes out the Parent Plus loan?
I unfortunately believe the answer is no.
Actually, not to go against you, Chris.
Yeah.
It's actually yes, and I know this for a fact because I had to research this a few weeks ago. So because it came up with a divorced family, divorced parents, and so they wanted to know if there was one parent, because of the way the rules are for divorce, that filled out the FAFSA, and the other parent wanted to do the Parent Plus loan. And either parent can take out the Parent Plus loan regardless of who fills out the FAFSA. It's just that the other parent needs to create their own FSA ID. But that was what we were told directly from the government.
Okay, that is very helpful. Okay, I'm going to move on to just 3 minutes to wrap things up here, because I know we're getting close to time. Look, thank you everybody for being here. At the end of the day, I hope that people will have to take out as little student loans as possible. The way I got here tonight is by having more student loans than I'd like to have. I've spent the entirety of the last 6 years trying to figure out how to access lower student loan pricing. If from the earlier presentation, using federal loans is the right way for you to go for the entirety of what you owe, please, by all means, do that. If you decide that you're curious about private loans and you want to see what rates you might qualify for, then I'd ask you to please consider checking out Juno, and I'm about to go through why. So all we do as a company is spend the entire year gathering groups of people who need to get student loans for the upcoming academic year and find lenders who are willing to negotiate on some of the rates and terms and features of loans so that we can provide a better experience to people than what you could get by going to the same lenders on your own. And we typically try to funnel that down to finding 1 or 2 partner lenders who allow us to do really interesting things that we think provide a lot of value to our audience. And the key of that for anybody listening right now is check your rates anywhere. If you're looking at private loans, I've heard a few people who mentioned that they've checked at Sallie Mae, at College Ave, at different places. Please do check those. And then just check what rates you might qualify for on Juno through our main partner lender as well. It's a really easy flow you can go through. If any of the lenders that you've already looked at are offering you a lower rate, then we have a really simple process by which we can match what rate somebody else offered. And there's 2 key things to keep in mind here. One, if for any loan that you use through our main partner lender, we would pay you 2% of your loan cash back, effectively a negative origination fee. And if you find a lower rate somewhere else and you go through that rate match process, we increase that from 2% to 3% cash back. The process for getting a rate match is pretty simple. Again, please, by all means, shop around. Don't trust me when I say we can put good rates in front of you. You just check your rates after that on our through our partner lender on our site, and a link that Debbie will send also in tomorrow's email and some of the emails you've already received. And then you can either just email us saying that what rate you want to match, and we'll tell you just a single document that you'd need to send to us in order to complete that. Or there's really about a 30-second form that you fill out that also initiates a rate match, and we can fill it out that way too. This is really meant to be as simple as it possibly can be. Many people do this with us every single year, and I hope that if you are in the market for a private loan, you'll give us a chance to prove that it is simple and to deliver that value to you. So really quick recap before we hop back into Q&A. Whether it's for this upcoming academic year or for the next one, please do consider negotiating your financial aid award letter. If you need loans, in most cases, you should use the Federal Direct Stafford loan first before you look at anything else. If you need more money after that amount, then that's when I would consider the trade-offs between a Parent Plus loan and a private loan, wherever you get it from. And if you're considering a private loan after all of that, then somewhere in your process, give us a chance to try to win your business as well. Throughout all of this, if you have any questions about anything related to paying for college, whether you use Juno or not, you can always sign up for free one-on-one advice from folks on our team who've been doing this for years. This is all we do during the summer, and we'd be more than happy to help you, whether it's thinking about strategies to negotiate your aid, reviewing appeal letters, walking you through calculators on how much different loans will cost over time. These are things that we do all day long, every day. And with that, I'll just return to seeing what questions people have.
Chris, is a good question about, we're encouraging people to shop around. I really, do want to emphasize that. You should, go to a few lenders, see what rate they offer. Just to summarize some of the things that Chris talked about and what was in the that I've shared answers to. That first application that you put through that gets a hard credit pull will have a slight, ding to your credit score. But after that, any other subsequent loan applications that you put through will not. And the bureaus know that people are shopping around. And so there's a 30-day period where you can go to as many, private lenders as you want, and you won't have any additional impacts to your credit score, just that initial slight one. But the other question here is, so if people go to multiple lenders, does it matter which lender they get the lowest rate to and bring that to you? Like, do you only look at rates from certain private lenders, or any private lender?
Sorry, would you mind repeating that? I was also just answering a few questions.
Sure. Will Juno, kind of look at and try and match the rate from any private lender, or only certain private lenders?
A very long list of lenders. Everyone I've heard on today's call, we match. Effectively anything that you'd find on Google, we match against. There's sometimes very small credit unions and new lenders that pop up where we might not be able to match it by default in our automatic process. But if those come up, then I'm more than happy to take a look at them as well. And we can typically turn around an answer to you in a couple of hours. But it really is meant to be fully comprehensive. There's no gotcha here.
Another good question I think applies to possibly more people. A question about if a parent applies for the Parent Plus loan, then changes their mind and decides to use a private loan, can it be canceled before confirming the funds?
Yes.
Yes. So any loan, even just the opposite, even a private loan, even if you accepted it, and then let's say you just found out about Juno and you wanted to share your rate with Juno and they can give you a better loan. If the first loan has not been dispersed to the college, you can cancel it. Let's see, what else do we have here? Oh, a question about families with multiple loans. Oh, sorry, more than one student in college at the same time. So if somebody has two or more, students in college at the same time, do they have to take out separate loans for each student?
Yes, is the short answer. And that's true for both federal and for private loans. But this is a great point because one of the key things to understand is that Congress simplified FAFSA over the last year. And one of the things that changed when they updated FAFSA is that up until last year, if you had more than one child in college at the same time, then the amount of aid that was calculated was higher. They took into consideration that you had a higher cost burden because you have two kids in school at the same time. Today, it's no longer the same way by default. The formula that the financial aid office uses to determine how much aid your family is eligible for doesn't give you a benefit for having higher expenses at the same time, but it's one of the top reasons why you can submit an appeal for more needs-based aid. And so what you typically have to do is inform the financial aid office that this is your situation, provide proof that there's a second student in the family who's attending college, and you provide that proof by typically showing what the tuition bill is or some other documentation if you don't yet have a tuition bill. And so I would just recommend, because that's a very tough situation to have to pay for multiple kids at the same time, make sure you can get as much aid as possible before you look at the loan process for those children.
So a question about the timing of when somebody should be researching. Should I be researching private loans now for the fall? Does the clock on paying back the private loan start when the school is paid or once I accept the loan agreement?
Great question. The clock starts once the school is paid, not when you accept the loan agreement. The general process for private loans, and that statement is true for both federal loans and private loans. The process is generally you check your rates. You'll typically see quotes in about a minute. Then you submit a full application. Say that takes about 10 minutes. You'll find out if you're approved either same day or typically within 3 days. And once you're approved for a loan, then you have 30 days to decide whether or not you want to use it. During those 30 days, those rates are locked. At any point during those 30 days, you can decide to sign the loan, which is effectively an electronic signature telling the lender that you tend to use that to pay for the upcoming semester. And then the school, basically the lender contacts the school and asks if you are or your child is an incoming student and if the amount they want to borrow is less than the cost of attendance. They'll say yes, and then the money effectively is just sitting with the lender waiting to get wired to the school on the tuition due date, which the school communicates to the lender. So the money does not accrue interest for you until the school requests that it is sent to them on that tuition due date. And you can you can reduce the loan amount before it's sent to the school. You can cancel the loan before it's sent to the school. You're not truly obligated to take it even after you've signed it.
So Chris, there's a question about how somebody can make an appointment with someone on your team.
We'll send you a link tomorrow that gives you, if you're not on our site, there's a couple of different places. You can just click a button to book a Zoom time with someone on our team. We'll also make sure to include a link in the follow-up email to this for you to be able to do the same thing.
Don't know, Chris, if you have any information or thoughts. Somebody's asking about a HELOC versus a private loan.
It's a good question. I've gotten this a lot the past couple of months. So HELOCs were, I'd say, a lot more popular to pay for school 2 years ago than I've seen them be today. The pricing on home equity lines of credit has gone up quite a bit. Been seeing closer to 7 to 9%. And in a lot of the cases where I've been working with people, when they check what private rate they're eligible for student loans, they've found that they're cheaper than what they could get on their HELOC. So if it's something you're considering, I would just make sure that you at least compare your HELOC rate to what your private loan rate might look like. Because HELOCs are probably the most expensive today that they've been in the past 10 years.
A question, this question is sometimes hard because it's situational, but there's somebody is sharing that they have enough in their 529 to pay for 1 year of college. Do you think it's better to wait to senior year so it can continue to accrue interest and use it then, or use it right away?
This is a very situation dependent question. And I'd say it certainly depends on your risk tolerance. A few things to consider here. Please don't take this as explicit financial advice. It's just how I would think about it at the moment. One, a reason to, I'd say, use the 529 now is because rates are very, very high today compared to what they've looked like for the last 5 years. That's because the general interest market for everything, credit cards to mortgages, is also very high. So there is certainly a strong rationale in actually using that 529 now so that you avoid having to accrue interest in a larger balance for a larger amount of time at a higher rate. The reason not to use the 529 now would be if you believed that rates were going down quickly, or that rates would go very far down, then you can typically refinance both federal and private student loans as long as you qualify. Refinancing a student loan is like refinancing a mortgage, but a little bit simpler. And so you're not locked into, as long as you qualify for a better refinancing rate, you're not locked into what you're currently being charged for the life of the loan. All that being said, to be totally honest, I would probably use the 529 now and avoid taking out debt for longer if I could.
Okay, lots of great questions. Lots of good answers, Chris. I really appreciate all of your expertise. And I encourage people to set up meeting times with people on Juno's team. As Chris mentioned, tomorrow we send out an email with a link to the recording and a link to the other resources that Chris has been alluding to, a link to sign up and create an account, and also where you can schedule time to talk with somebody and get more of your questions answered.
Thank you, Debbie, for hosting again. Thank you, everybody, for your wonderful questions and engagement. And yeah, I look forward to being as helpful as we can be.
Thank you, Chris. Thanks, everyone. And always feel free to reach out, whether it's directly to Chris and to Juno, or if you have questions, you can always send them to support@rhodescollege.com as well. Good night, everyone.
Good night.